Hi, I'm Steve LaFrance with Blakely Financial, and I'm summarizing the past 30 days in 3 minutes. April was another difficult month for both stocks and bonds. The S&P 500 traded 8.8% lower, while U.S. bonds traded down 3.8%. Consumer staples was the only sector to produce a positive return as growth stocks underperformed. Year-to-date, staples and energy are the only sectors with positive returns. The U.S. dollar also appreciated to its highest level since 2002 as the euro, pound, and yen all struggled with weak economic data and lower growth expectations. Our digital economy is stronger and more efficient than ever. However, we're now facing analog threats such as inflation, supply shortages, and war, which haven't been seen since the 70s. The short-term effects are unnerving, but our economy retains momentum. By and large, companies are better at adapting to new challenges as entrepreneurship has blossomed over the past couple years. Inflationary pressures continue to rise on many fronts. Pandemic-induced supply constraints are slow to improve, which have been further complicated and delayed by the Russia-Ukraine war and China's staggered shutdown of Shanghai. Employment costs continue to rise as workers pressure employers of every stripe. Mortgage rates have risen to over 4.6%, making homeownership more expensive. Commodity prices have popped, led by oil and gas, and inflation is forcing consumers to choose essentials over desires. Fed policy remains the driving force as the central bank raises rates and prepares to shrink its balance sheet to ease inflation pressures. It's a difficult and delicate balancing act as low interest rates and bond purchases stabilized the economy during COVID, but removing the two pandemic-era monetary policies is proving to be enormously disruptive. The Fed's forthcoming rate increases are unlikely to materially hinder domestic growth, at least in the intermediate term. The market's already pricing in a 50 basis point increase on May 4th, but how successful the Fed will be in containing inflation remains unknown. But it can be said that raising rates now may provide ammunition for addressing a future recession if necessary. In spite of the challenges, corporate earnings should increase about 10% in 2022. While not advancing at the impressive pace of 2021, it should be enough to support stocks as the year progresses. Bonds are also offering more favorable yields than a year ago and provide a level of safety during these more uncertain times. There is no easy answer or definitive path forward. This year's sell-off indicates that some degree of the Fed's tighter policy is already priced into the market. In addition, the list of market uncertainties remains long, including corporate earnings quality, economic strength, and the path of future rate hikes. Until the market receives clarity, volatility is likely to remain elevated. We'll remind you, the world's a crazy place. There's almost never a time when returns are high and risks are low. Let's stay focused on our long-term goals and seize the opportunities. Again, thank you for your trust and confidence.